Hey there, it is Phil Ratcliffe with Rebel Financial. Thanks for tuning in again today to another one of our broadcasts. Hope you enjoyed the last installment. We actually mixed it up and decided to talk about asset bubbles and go over some of the GameStop and cryptocurrency and different things that were really surging and to try to help people get a better understanding of things. So today we're going to do what we were supposed to do last week, which is a segment that I was putting out there for future of investment management. There's lots of things going on right now, and a lot of people are taking advantage of them for good and ill. And so I just kind of wanted to go over some of those developments, talk it out with you, and then look at where maybe some of these things are going, at least from our perspective, on how they can be used for good, for the betterment of individual investors, for those of us that are probably watching this, that are trying to make the most out of our resources to, protect our financial security, to accomplish your goals, help your family, hopefully help some charities and society out as well too. So let's dig in. So we look at this, I think one of the things to really remember now, and usually I don't have to talk about this so soon after recession, but the recession for a lot of people, especially people that have the money to be able to invest, and what so was not very bad. And for a lot of people that actually had money to invest and didn't get laid off, and a lot of white collar positions, you were able to work remotely, et cetera, you actually came out of this better than you went in. And so now the markets have just really taken off. And with some of these new technological developments we're going to talk about, speculation is rampant, and it seems like it's a thing to do. And it's not like this is something new. This has happened lots of times in history. Um, in our recorded history here, all the way back to the 1800s. But of course, you can find speculation back in Europe in the 1700s. And I'm sure, even though we don't necessarily have a lot of records of it, I'm sure there was a lot of it back in the Roman Empire and before, even in the cradle of civilization, as it may be. So there really is a big difference between investing and speculating. And so, what we work on as investment professionals and financial planners is investing for our clients. And investing generally takes a long time horizon. And so usually at a minimum, when we're talking about investing for our clients, it's at least 3 to 5 years, and that would be a short time horizon for us to where we would be more conservative. But when we start talking about longer time horizons, generally you can get a pretty good, not always, but a pretty good reversion to the mean, where we have a pretty good idea of the probability of the returns we're going to hit for people, somewhere between 8 to 12 years. So let's just say 10 years, right there, right in the middle. Okay, that's not generally a full market cycle. You're going to hit a recession, from historical context between that. But that like right now, we're still in kind of an era where large and just growth oriented is just dominating. But when you look at most periods, the last 100 years, that is not necessarily the case. Value tends to outperform. So even over this 10 to 15 year period that we're sitting in right now, is actually not cycled and is anomalous to the longer term. So anyways, we generally work in that area. And when we help our clients build strategies, et cetera, we know to a pretty high probability about what they're going to make on investments. Okay. And so as long as somebody's willing to kind of follow the rules, stay in that framework of how long they're investing, there's not a lot of risk. Now, of course, anything could happen, right? A meteor could hit the planet. You could have a zombie apocalypse. I don't know. But these things are so low event or probability of happening that to spend any kind of significant portion of your wealth to prepare for that or bet on that would be devastating in the long term, right? And there's not a lot you could do about it in the except for maybe Elon that could take a ship and go to Mars, right? But so that's investing. Speculating tends to be way shorter term, and right now most people's speculations are working out. Right? They're loading into cryptocurrency, or they're concentrating into these high growth tech stocks, or even some of the bio meds, etc. And it's just like everything is almost working out. Okay. And so, this happened right when we were in the tech boom. Everybody thinks they're a genius now. Everybody can trade, can get online, get an app on their phone, and boom, make some money. Why do you need to hire anybody? Why do you need to learn a bunch of stuff? It's easy. And for a while, that will persist, right? So I put this little article up here. We'll put the links below. I picked a lot of different sources here, just kind of for diversity of opinions, but good one still. This one's a good one from the street. You may know Jim Cramer or what so, but talking about some of the differences between what is speculation? If you're investing in options or in futures or currencies, if you're short selling, if you're using leveraged ETFs, so where it's like 2 times or 3 times the S&P, or inverse to where it's like if the markets go down, you'll make money. These are very speculative. They're not for most people, and absolutely you can make money in the short term. But I will tell you, when we actually do academic research and look at the long term of people that pursue these types of strategies, the results are not very encouraging. So for professionals, when you look at professional traders, when you actually do a risk-adjusted comparison, say to like the S&P 500 or what so, now again, you got to do risk-adjusted. So for how much risk they took, then the underperformance is something like 1 to 2% per year over a longer period of time. And these are the professionals. So when you get into just regular individual investors, absolutely you'll have tails on a distribution, meaning you'll have big winners and you'll have big losers, but the average is even worse. I mean, the average investor that's even investing for the long term generally underperforms the market, between 1 to 5% per year, depending on the time period you're looking at. And the length of time as well too. So it's significant underperformance. And so don't get caught that because you won in the short term that you're going to win in the long term. It's kind of like thinking about a gambler. Say somebody spends 10 years gambling, going to the casino or buying a ticket, and then one time, say they win $20,000. You think that person's never going to gamble again? No. Eventually, over some time frame, they're going to give it all back. And so it's kind of the same thing with these things, because it is more analogous to investing a lot of times than it is, or to gambling than it is to investing. And so generally, if somebody wins and does well in the short term, they will continue to do that going down the line. And when you have enough of these together, that's the average that I'm telling you about. But could you win? Absolutely. I'm not saying that you can't. There are always statistics that are outliers, right? But the average of us, if we do this enough, we will lose, okay, compared to what we could do by investing. And investing is great. I mean, depending on how aggressive or conservative you are in the long term, you can make anywhere between, 5 to 12% per year. Just depending on if you're willing to have more volatility along the way. And we call that more aggressive. Even though if you do it a long enough time period and you're very disciplined about it, there's not much risk of loss of principal. So I really want to point that out, because with a lot of things that are going on right now, everybody thinks that investing is just easy. You should make 20% or more per year, and that is absolutely an illusion. Okay, long-term rate of return for like stocks, equities, where humanity is actually building utility, where exponential growth is actually happening that could sustain these things, is somewhere between 8 to 15% per year. Okay. And so depending on the time period you're looking at, and if you take a long enough time period, so maybe like 50 years, you're looking at like 10 something percent per year. And that's pretty aggressive. That's like being all in stock. Okay. So, and we have been growing exponentially as a species and a civilization for a long, long time. And it's interesting too, because we'll get some people that are just like, well, I should make 15%, per year on my returns. But then they're also thinking that humanity is never going to go anywhere, that the U.S. debt is going to destroy us, that humanity in general is doomed. And it's just like, how can you hold these totally opposite things in your mind? Because without humanity's exponential growth and success, investments can't grow like that. Okay, so like these things go together. All right, so anyways, so let's look at some of the new developments that are coming along. So when we look at this, fractional shares, and so Schwab's one of the biggest players out there with them. They weren't first in the game or anything like that. But there's a pretty cool little article that in a very how do you say it? It's almost like a very consumer facing explanation with lots of pictures and graphs and stuff like that of why are fractional shares good. Before, if you wanted to buy a basket of stocks like this, you might be looking like minimum of investing like $15,000, $20,000. Well, in this example, it's 6,000, but to get enough to actually diversify. I mean, these are just big names and very growth heavy. I don't know that I would do that. But anyways, and then for us as investment managers, to where we could get a few hundred stocks and some bonds, mix these things together, a lot of times we need like a $500,000 to be able to do this. And that's just because you look at, like, say, one stock that is $1,000 a share or something. You got to buy one share, right? Now we can buy fractional shares, right? And so fractional shares, we could buy a fraction of, Apple, or a fraction of some stock that's really expensive, like $13,000 a share, or something like that. And you could just say, I want $5 of it. Okay. So this is a great development. This is going to kind of equalize the playing field between people that have a lot of money and those that don't, theoretically. Okay. So this is fractional sharing. We're very excited about this. It opened out actually into individual investors a lot earlier than it did on the institutional side, and we're still having a tough time like getting Schwab and TD Ameritrade and E-Trade and the big brokers that we're used to offering fractional shares for us to be able to serve our clients. We've actually had to add a different custodian just to be able to offer it to our clients. And so that's the one that we use, is Interactive Brokers. And I put this on here as another article that I thought was pretty good. It looks like they keep it up pretty well in terms of just kind of ranking companies that have fractional shares and what's the pluses and minuses of them. Like the Interactive Brokers one that we use is that the downside of it is it's too advanced for most investors. But again, when people use someone like us, we're kind of like, that's good for us to be able to have all the tools that we need to be able to work for you, and you don't have to necessarily interact with that. So anyways, you can kind of look through this list. Again, we'll have the links below there so you can kind of see it, but this allows people to be able to buy things that they may not have been able to afford before. And then another new development, blockchain. And so hopefully you've heard of this. If you haven't, Bitcoin is kind of the name that's synonymous with the whole technology that kind of started it all. But really, some of the most exciting things about cryptocurrency is the technology that it's built upon, is blockchain, and what it could do to make the world better. So, I'm not a big fan necessarily of Bitcoin or Litecoin or some of these coins that are just to be traded, or some people say they're digital gold, but they really don't have a lot of utility beyond that. There's a lot of the Ethereum-based tokens that you'll really hear a lot about that are solving a lot of problems. And at the bottom of this article, it does talk about some of them down here, where it's talking about, facilitating, trade and finance. And of course, everybody knows, because they call it cryptocurrency, that yes, you can use it to buy stuff and use it like currency, but it's going to help us hopefully solve problems of like transferring property and using smart contracts to deal with each other, and filling supply chains and making things to where they can be publicly available, but still protected, and you can trust the data that's in them and be fast. There's even some of the financial companies like Vanguard or whatso that are trying to list some of their funds, their tickers, using blockchain to where maybe eventually we won't even need exchanges and custodians. So a lot of this stuff, we're going to be able to cut out a lot of the middlemen. What if we could vote like through blockchain, something that was inviolable, that was like pretty much of the people, peer to peer, decentralized, not necessarily controlled by the government, but I mean, again, who knows what future technology could do, but for what we understand of encryption and what's so inviolable, and you could just do it from a platform like Facebook. You're like, well, there would be a lot of fraud. Well, think about it. If you had to do your fingerprint, plus it did facial recognition, plus you had to answer some security questions, heck, that would be a ton more secure and less able to be fraud committed against than going in and showing your driver's license and a utility bill or something like that. That's like ridiculous, that we would hold on to something like that as like um, better. So, anyways, there's a lot of cool things that blockchain that hopefully will do for us, and it's going to cut out a lot of the middlemen, which a lot of the times we had before because we don't trust each other, right? And if we could do in the cloud to where identities can be verified, they see that you got the money, they see that you own the title of the house, and those could be automatically exchanged, then you get the money, they get the house, and not all of these people have to be, oh man, that would be great, take a house transaction down from 6 to 8% down to less than 1%. That would be great, right? So that's just one example of what this technology might be able to do. And I gave you a bunch of them, and you can read through this article. It's pretty cool. I like Investopedia for some financial topics, but I don't want to use it too much on this. So we had some diversity in here. And then the next thing, artificial intelligence. It is like the buzzword right now. Everybody's talking about artificial intelligence, this and that and that. And of course, when we think of artificial intelligence, we think of Tony Stark and his AI. It turns into vision, etc. It's like, no, we're not talking about strong AI like that. We're probably decades away from that, more than likely. We're talking about like smart algorithms that get better over time, that are good at little things, like weak AI, is what they call it. And you're seeing that all over the place, from driverless cars to your phone knowing what you want to even Google, when you type in 2 letters, knowing the whole dang sentence that you want to search for, right? So AI, in our realm, would be a lot of the stuff we do already. I wouldn't necessarily call it that we're there yet, but I can see it coming. We use a program called iRebal with TD Ameritrade. And it's probably one of the better rebalancing things that I've seen out here. And I've looked and used and tried a lot of things. But we kind of program some rules into here about how we want to take care of our clients' platforms. And then it helps us monitor and suggest trades. And it really speeds up the process. And so, hopefully over time, we're going to be able to leverage this and things like it that get better for a lower cost. And then we're going to be able to help more and more people take care of their portfolios and actually invest, not speculate, still be able to take advantage of some of the things that are out there, and take money off the table when you do kind of get some of these asset bubbles and stuff that we were talking about, that we may be participating in. Okay, so you put all these things together, fractional shares, and the blockchain, and weak artificial intelligence. Some of the lower cost trading, more companies are coming out with products and different things to solve problems. And since they do have to compete against lower price, it's like overall reducing the prices for investors. Like all of these things are good. And so that sounds like, whoa, this is like an awesome utopia of investing, right? Now, let's not get too fast here. Okay, so let's see. Robinhood has been a darling. And you know what? I have a Robinhood app. I have a lot of financial things because I play with things to see how we can leverage some of these technologies for our clients in the future responsibly and as a fiduciary. I'm going to get into that next. But it's a great app from if you use it right. But the way that it's built is very gamification. It's like an online almost casino, right? There's all these flashy things, and when you buy something, it's like, boo, you did this, and then it'll do things like, oh, you sold that. Do you want to buy it back? And a lot of these things are built around behavioral heuristics and things that we have as human beings that are there to optimize them making money, but may be bad for you financially. Okay, now right now, when people are making so much money, it doesn't seem like that bad a thing because you made money. But if you made 50% and they skimmed like 5 or 10% off of what you would have made had they executed your orders better or not pushed you into this behavioral, that's really expensive, okay? Because you say, oh, well, I still made 50%. Well, you are not going to continually make 50%. You're in a good time right now. A lot of times, like I said before, people are going to lose that back. And if they skimmed off of you here and then we average that all out and your long-term rate of return only ends up being 5%, and over time, their fees amounted to 1 to 3% of yours, like you didn't even hardly make inflation. Okay. And the whole point of investing is to beat inflation so that your money is worth more in the future than it is now. And so, again, it's a free country. We're capitalist, right? People can do what they want to. But again, they should disclose it. People should know what's happening. But instead, a lot of these actors out there, a lot of them, we're talking about this fractional free trading stuff. And again, I'm not anti a lot of them. It's just I just don't, to me, this whole game of telling people that they get free trading is wrong because it's not free. Okay. So they make money on lending from your securities. Schwab makes 50% of their profits from basically just kind of shafting people on their cash holdings. Like they're giving them like 0.2% when Schwab can make 2% on it. So they're like just taking like a percent and some off the top, right? And then I've even noticed at using them as an institutional person, it's very difficult for me to give my clients if not impossible, into good cash earning things inside of Schwab because they know they make that much money. And so they're gaming the entire system to make sure that you don't. Okay. The spreads are, I think, where a lot of this money's come from, where they're talking about commission free. Because if you ever read the Michael Lewis book, where he goes in and talk about, well, the title of it's Flash Boys, and he talks about, how basically the SEC is allowing these companies and these traders, we call them predatory traders, to front run investors. So they give kickbacks back to the exchanges so that they can communicate microseconds ahead of you. And they have all these different order types to tell when you're about to make a trade. So they can say, oh, so and so wants to buy, this stock, for $10. We can go in real fast and buy it for $9.90 and give it to them for 10. Right? But that custodian was supposed to get you best execution, which means that they should have got it for you for $9.90. Now the SEC's argument is like, hey, this has really reduced costs so much for individual investors. It's a gray area. We're not going to enforce the law. But front running is illegal based on legislation that was put back after the Depression. So if they really want it to be that way, they need to change the law. Like our government organizations need to enforce the law as it is. So, anyways, you can kind of see here the SEC, even though they're not really enforcing the law, is still coming after Robinhood. And this was before all the stuff from the GameStop stuff saying, hey, you are not disclosing to customers about how you make money, where, and you're not giving people best execution. Because obviously, the worse execution they can get away with, the more kickback they're going to get, because basically what they're doing is selling naive investors to sophisticated investors. And it may seem like fractions of a cent, like the old Superman, let's just round off the fractions of cents and put it in an account, we'll make lots of money, right? It's still wrong, still stealing, right? So, anyways, be careful. These people are not on your side, regardless of if they try to take a name like stealing from the rich and giving to the poor, when ironically, it's probably actually the opposite, right? So, and I would say a lot of them are on the same boat. I'm not throwing anybody under the bus. Again, we live in a capitalistic country that this is the name of the game right now, is maximize my profits at the expense of everybody else, which we do not subscribe to. I like capitalism. I think people should be able to be rewarded for doing good things, but it should be like a responsible capitalism, to where, yes, we should be rewarded for working hard and creating good things, but not at the expense of other people, right? We can raise all boats at the same time or make the pie bigger. We can take care of our employees. We can take care of our communities. We can take care of our customers, and charge them what's fair, not just what the market will bear and what's the maximum I can make, right? So, so what's a fiduciary? So fiduciary, this has gotten a lot more press. A fiduciary is somebody that has to act in your best interest. And again, we're going to put all of these links down here so you can read through and dig into it. And that's not what this is about, but it's what we are. It's what some RIAs around the country are all the time. You want to find somebody that is a fiduciary all the time, not sometimes. You'll get a lot of brokers that are also RIAs that'll say, well, we're fee based. It's the same thing. It's not the same thing. Okay. It's like sometimes they're fiduciary, sometimes they're not. How are you supposed to know? That's like complicated too much. And so they have to work on a suitability rule versus a fiduciary rule. And you can kind of see the differences here. So yeah, they got to sell you something that's suitable for you. They don't have to necessarily disclose all their conflicts of interest. And generally, their loyalty to their employer is before that of their clients. With a fiduciary, you have to give recommendations that are in your client's best interest. You have to disclose your conflicts of interest. You have to put loyalty to your clients above everything else and act in good faith. So you want a fiduciary, okay? In the financial world, when our whole system of economics is pretty much set up to where the MBA programs around the world have taught all the people that are in charge of these companies just to maximize profits at that expense of all other stakeholders. You need somebody that's going to be on your side, right? Even sometimes if it's to help you from you. When a lot of people think that their speculation is the norm and that's what they're going to make forever. Sometimes we got to hold our clients back. It's like, yeah, you missed out on making 50% this year. We only made you, 18. But when those people would lose 80%, you're going to go down 10. And when we put this together over long periods of time, you end up with more wealth investing than you do speculating most of the time. Again, there will always be outliers, and of course, the media loves to pick those people up because they're great stories, right? Um, so, to us, we think that a lot of these technologies can be used responsibly. Kind of like what I said before. I said not so fast. We can use fractional shares to bring awesome, sophisticated portfolios to smaller investors. That's a really good thing. One of the great things I like about fractional shares is that because most of the time to date, when we invest for our clients, because it's tough to get that diversification. So we don't want all our eggs in one basket. We want them spread out. We don't even want them in a set of baskets. Like when we were looking at, this basket right there, that's way too concentrated in large US countries. There's hardly any foreign here. It's almost all growth oriented. And there are things that are pretty appreciated right now. And so to us, that's a very expensive thing to do with a low probability of a good rate of return the next 10 to 15 years. Who knows what it'll do in the next 1 to 2? I'm not here and talk to you about that. But, what if we need to buy some more small companies, some international companies, some value companies, some energy companies and financial companies that are on sale right now that aren't darlings? We will be able to do that. And when we buy them in the funds, the ETFs and the mutual funds, we get that. But the fund companies control the whole process, which has its protections in it. Since they have this big economy of scale like Vanguard or DFA or Fidelity, like they're going to trade well for us. They're not going to let those people get them, hopefully. That's what they're supposed to be doing. But they vote all the proxies. So they're going to do the thing that's the safest for them generally, okay? Which is to say, all right, we want you as board of directors and executive staff to run the company in the way that's going to make the most money and not illegal, right? There's a lot of area of companies doing wrong or paying their executives way more than their people or not giving back to the community or lobbying to make the country worse just so their profit margin will be better. Most of us do not agree with that, right? So if we own the companies ourselves instead of through those intermediaries, then the proxies will come to us. And so we can vote to fire their boards. We can vote to limit executive compensation. We can vote to tell the companies to lobby against companies being able to lobby, right? We could change the world because right now money does rule the world, whether we like it or not. But most of us, through our retirement accounts, through our kids' 529s, through whatever, where we own them. We could tell them what to do. We just don't. Okay. So to me, we can still make these good investment returns. We can make the world a better place, and we can still accomplish all of our goals, which right now we're not leveraging our power to be able to do. So I think fractional shares, from the standpoint of letting us build awesome portfolios for smaller investors and for us to be able to make a better world without even really changing the game of investing your money to make those good long-term investment rates, is a phenomenal opportunity. Okay. So that's number one. Number two, when you look at the blockchain and what's out, I think you're going to see a lot of cool things happen where we can do things with each other. We can do peer-to-peer lending. We can cut out a lot of intermediary companies that were siphoning off the system, like credit card companies and title companies and banks and what's out. Now, are they going to go quietly into the night? No way. But over time, I think this will happen. It'll be a good thing. We'll be able to invest in some of these things. So, right now I'm looking for safe, good ways to start to add a little bit of, again, we call it cryptocurrency, but a lot of these Ethereum-based tokens and what's so, they're kind of like a mixture between a stock and a technology and a commodity. Like they have utility like stocks we talked about before. And it's really early. And so, again, not a lot to where it's speculative, but as a long-term investor, for what that will come out to. And then using some of those AI type things, because like one of our goals as a company is to keep helping smaller and smaller clients, and we are leveraging this to be able to, cut our overhead down so that we can serve people that are smaller investors to actually be investors and not speculators. So the choice shouldn't be, I don't invest and I put my money in a savings account that pays me less than a quarter of what inflation's going to be, or I get on this DIY app to where it's basically a bunch of sharks trying to eat me, right? If you try to hire a firm like us, traditionally, an RIA that's a fiduciary that does good financial planning and helps with taxes and investments, I mean, their minimums are generally $500,000. Like, we don't have any minimums. And we do have monthly fees, and our lowest is $50 a month. So again, it's not cheap. But again, it's kind of like a gym membership. And if we can leverage a lot of this technology to help us automate some things, we're going to be able to drop that even lower. But again, I think where we're going is with these technologies can be great things. I think you need to think about how you're going to access them. If you're sophisticated and you can stay up to date and you think you can swim with the sharks and beat them, then more power to you. If you're like, wow, this really excites me, I'd like to invest, but I know I need somebody to sit at the same side of the table with me, then hire an advisor. One of our groups that is our biggest affiliation is called NAPA, and it's fee-only fiduciary advisors. And we tell people, it's like, if you really want somebody to help you with coaching and financial planning and taxes, etc., NAPA is kind of like the Jedi, like if you like Star Wars, in the financial industry. So pop in your zip code or your city, and find some of them, interview some of them, and find somebody that kind of jives with you. So anyways, that is our spiel for kind of the future of investment management and a lot of these exciting technologies that are going on. Hope it helps a little bit, give you a little bit better understanding. Really appreciate you tuning in. Next week, we're going to have our actual live broadcast on, where we've got Ricky Taylor in from the Association of African American Financial Advisors. Me and AC, one of our financial coaches, will be on talking to him. The week after that, Tony and I are going to do our book review, Death of the Banker by Ron Chernow. And then after that, Tony's going to have the next financial subject. And since he'll be in the middle of starting to crank out some tax returns, he's going to go over common tax questions and things that you can do to make things better. So hope you guys are having a great week, staying warm, staying healthy, safe, and hopefully we'll see you next week. See you then.